Hey everyone, in this video we're going over AT&T stock, ticker T. We'll be talking a little bit about the merger of Warner Media with Discovery. Now before we get into the details about this stock, if you could smash the like button, it really helps the YouTube algorithm, it helps get new viewers to the channel, and we're still a small channel. And if you haven't subscribed yet, please subscribe. Now let's get into this video. So, the first thing I want to go over is the stock price. Now this presentation was made yesterday. I'm going to be uploading it today on Friday, December 3rd. So as of yesterday, the stock closed at $23.05. I believe it was down this morning, and I believe now at this moment of recording it's actually up. But if we just look over the last 5 days, even with the 3.7% gain yesterday, the stock was down over 4% in the last 5 days, over 8% in the past month, over 21% in the past 6 months, over 21.7% in the past year to date, and over a 5-year period, if you held this stock for that long, you're down almost 43%. Now the thing to keep in mind is this does not include the fact that you were paid dividends across these years and these quarters. You were getting a pretty high dividend from AT&T along the way. So when you add that back, the picture doesn't look nearly as dark. Now, AT&T is trading for less today than it was as far as, forgetting dividends, just share price alone, it's trading less today than in the 2008 crash. It has pretty much not been this price since around 2001. Now, with the recent pullbacks we had, bringing it to this price, it really got me interested in, is it a buy today? So I started digging a little bit. So first, I just want to go over their forward PE. They trade for a forward PE of 7.35. This is extremely low. Now, AT&T has always traded for a low forward PE, but just to put that in perspective, Verizon currently has a forward PE of 9.4. So, it is a different company, but I would actually argue you should have a higher PE, forward PE for a company like AT&T when they have assets like Warner Media that should actually basically demand a stronger price to earnings. And that's one of the reasons I think they're splitting off Warner Media, and we'll get into that later. Now, as far as dividends, they have a forward annual dividend yield of 9.36%. They pay $2.08 a year in dividend. The past dividend, the trailing annual dividend, so the last 12 months what they've paid out was 9.36%. Now this dividend will be cut, but as of right now this is what it is. It's going to be cut because the cash flows will go down when they get rid of Warner Media, which is totally normal. That's way too high of a dividend anyways. Now AT&T's dividend basically is going to be cut nearly 50% in the Warner Media deal. Now AT&T said it's going to expect an annual dividend payout ratio of around 40 to 43% of anticipated free cash flow of $20 billion plus. So Simon Flannery of Morgan Stanley observed a research note. He said that if we assume an $8 billion payout, this would be a nearly 50% reduction from current levels of some $15 billion and would put the stock on a low 4% yield. He also says that buybacks could also be a possibility down the road. Now, when this article came out, the stock was trading around $32 a share, I believe. So at today's levels, the dividend, even being cut after 50%, will still provide close to a 5% yield. So there's plenty of free cash flow to fund growth, lowering debt, buybacks, all of this stuff with the extra 60% of anticipated free cash flow that they'll have, even after paying you 5%. And that's because the stock has dropped so much that, if they're still going to pay the same amount of money out, but you get to buy in at a lower price, your yield is higher. Now, the one thing everyone is always worried about when looking at AT&T is their debt, and it's really simple. It's because debt is scary, especially when you have insanely high amounts of debt, because it is hard to pay off if you don't keep that high cash flow to keep paying it down. And with a company like AT&T that did so many acquisitions, they just added debt after debt. So this is a little bit of their balance sheet here. We can see in cash and cash equivalents, they have $21.27 billion. They have another $16 billion in receivables. They have another $3 billion in inventory. And they basically list their total current assets around $57 billion. Now, as far as liabilities, they have total payables of $51 billion. Now that includes their dividend of $3.75 billion and their accounts payable of $47.9 or so billion. Now, their payables and their total current liabilities are basically totaling up at 81.6 billion, so much more than their current assets. Now, when you look at total assets, it shows 547 billion. Keep in mind that's, it's including property they own. It's a lot of goodwill things when they bought, companies that it's not actual cash. It's not actual, it's things they could sell if they were willing to sell away those assets, like, brands that they own, property that they own, things like that. But it's not going to help them if they want to keep it, pay down the debt. So only cash flow is going to help them pay down the debt. So just to get a clear idea, their cash on hand is 21 billion and their total debt is around 209 billion that they owe. So that is the one huge negative thing about this stock. But we'll get into that a little later. They are going to be moving some of that debt off into the new company, I think around 40 billion or so. And they do have good cash flows to keep paying down this debt and being able to make those interest payments. Now, their earnings. This is what's important. How's the company actually doing? And especially, how is it doing against expectations? Because analyst expectations, they make these expectations and they have price targets based on those expectations. So if they're beating those expectations, you would theoretically assume that they should also then be valued at higher than those price targets. And AT&T has consistently beaten expectations for earnings. They are doing really well going into 2022 and doing better than coming out of 2020. They're doing much better than people expected them to be doing at this point. Now we're going to look at the numbers, and we're going to really just go through the most recent earnings report. It's only a couple slides to get a real detailed view of what the management is telling us is going on in their business. So the first slide is just to talk about their business priorities. They believe that they continued consistent execution across 3Q of 2021. Their priorities are growing customer relationships, being effective and efficient in everything they do, and being able to deliberate capital allocation. Now, as far as growing customer relationships, they put 3 bullet points: most postpaid phone net adds in more than 10 years, fiber share gains with sequential increase in net adds, and HBO and HBO Max global subscribers nearing 70 million. Now, as far as being efficient, they increased cost efficiencies, enabled reinvestment and growth. They're on track to achieve half of $6 billion of cost savings by the end of 2021. Their mobility EBITDA growth of 3.6%. Their shift to fiber is driving consumer wireline EBITDA growth. And as far as capital allocation, they announced or closed $55 billion plus in asset monetization and generated $26 billion in free cash flow. And that was over the past 12 months. They closed the DirecTV transaction. The Warner Media deal is expected to close by mid-year 2022, and they have the right capital structure in place to support future success. Now let's get into subscribers. In 3Q21, they had solid subscriber gains in areas of their market focus. So we're going to break that down to wireless, fiber, and HBO Max. For wireless, postpaid phone subscribers in 3Q hit 66.4 million. This is up from 65.5 million in 2Q of 21, and if we're going a year ago, it was 63.5 million. So it is slow and steady, but continued ads growing. Their net ads for 3Q were 928,000 ads in this quarter. This is much more ads this quarter compared to the year ago period, 3Q20, which had 645 million net ads. So their churn also is pretty steady, around 0.72%, but even with that churn, they are gaining subscribers. Now let's jump into fiber. Now, AT&T fiber subscribers hit 5.7 million in 3Q21, up from 5.4 million last quarter. And if we go a year ago, it was 4.7 million. So the growth is really nice in fiber subscribers. Their net adds were lower this quarter than last quarter, only 289,000 net adds, but they continue to add. They have 37% penetration, which is great. Their penetration is increasing. And last but not least, we're going to go over HBO Max and HBO subscribers. This is important because of the Warner Media deal. It is good to know how many people like this content, etc. And in 3Q21, they had 69.4 million subscribers across both HBO Max and HBO and regular HBO. This is up from 67.5 million the quarter ago, but if we're looking year ago period, it was 56.9 million. So really high growth, steady growth. But we do have one red flag, and that red flag is domestic subscriptions. Now, domestically, HBO Max and HBO has always went up 38, 41, 44, 47, but in the most recent quarter it dropped from 47 million to 45.2 million. So the churn clearly has eaten some of those subscribers. They've moved away. Now they may come back. Overall, they do have more subscribers because internationally, HBO Max and HBO has picked up and basically made made enough additional subscribers to make the overall picture continue an increase trend. Now that's good that overall the number is increasing, but we all know that international subscribers have lower ARPU, so they're paying less average revenue per user than users domestically. So it is something to keep in mind. But as long as the overall number continues to rise, I do think domestically it will continue to rise down the road again. Now let's go over some of the financial numbers. So their adjusted EPS for 3Q21 was 87 cents. This is against 76 cents a year ago, so a nice rise in earnings per share, but 2020 was obviously a rough year. As far as revenue year over year, in 3Q21 they did 39.9 billion. That is a drop from 42.3 billion, but the biggest impact was US video impact. So they show that in black, and you can see that if you're just looking at revenue excluding US video, it was 38.1 billion in revenue this quarter versus 36.4 billion a year ago. So it has increased, but the US video impact, the box office being closed, etc., for the Warner Media business has affected it to have it a little bit lower revenue. Now, cash from operations, free cash flow, and capex, we basically see 12.1 billion in 3Q of 2020 and 9.9 billion this quarter, 3Q21. So it has lowered. We also can notice they are spending more on capex, so $4.7 billion on capex this quarter versus $3.9 billion a year ago, which should hopefully lead to future growth and more cash flow down the line. So reported EPS, 82 cents versus 39 cents a year ago. That's pretty great. Adjusted EPS, 87 cents versus 76 cents a year ago. That is up 14.5% year over year. They believe they had strong cash flows and they have a good liquidity position. Cash from operations was 9.9 billion, capex 4.7 billion, gross capital investments of 5.7 billion, 5.2 billion of free cash flow. Their year-to-date dividend payout ratio has been 63%. This is higher than they'd like. They will be getting it down after that transaction to the 40 to 43% range. $10 billion of asset monetizations closed, including the DirecTV TPG transaction. Now that was the overall 3Q numbers. Let's break this down into their segments to kind of get an idea of how each segment is doing. So first is communication segment. So we have mobility, business wireline, and consumer wireline. They had strong revenue and EBITDA and subscriber gains. Revenues were up for the mobility 7%, service revenues up 4.6%, strong EBITDA and service margins, 928,000 postpaid phone net adds, 249,000 prepaid phone net adds. So mobility was strong with $19.1 billion in revenue, $8 billion in EBITDA, 41.7% EBITDA margin. That compares to a year ago at $17.9 billion, $7.7 billion of EBITDA, but a 43.1%. So their margin came down a little bit, but they are making more money, higher revenue, more EBITDA on mobility. Then for business wireline, margins remain strong with a refined portfolio. Revenue comps impacted by the pandemic demand 3Q20 and proactive portfolio rationalization, emphasizing core network and transport connectivity. Okay, let's just get into what the actual numbers are, which is 5.9 billion versus 6.3 billion a year ago. So the revenue did drop in business wireline. 2.3 billion in EBITDA against 2.5 billion a year ago, so a slight decrease. Margins remained kind of the same, 38.5% versus 39.9% a year ago, so a slight decrease as well in business wireline. But then when we go to consumer wireline, broadband drives revenue and EBITDA growth. They had solid AT&T fiber gains with sequential net add growth, and their EBITDA and revenue growth as fiber strengths offset the legacy declines. So they know that legacy type of products that they have are declining, but fiber is growing. So consumer wirelines had $3.1 billion in revenue versus $3 billion a year ago. $1 billion was EBITDA against $0.9 billion, so slightly higher, and their margins have remained about the same. It's 30.5% versus 30.4%. Now I'm very confident with mobility, with 5G, their revenue should continue to grow. More products other than just your phone will be using 5G chips. It's going in cars now, it's going all over. So I do think mobility will have strong growth ahead, and I do believe fiber will have strong growth ahead as well. Next, let's look at Warner Media segment. So this is the last segment in these slides, and then we'll get into some price action and what we think the stock is worth. For Warner Media, they did $8.4 billion in 3Q versus $7.4 billion a year ago in 3Q 20 versus 21. They did $2.2 billion in EBITDA against $1.9 billion in EBITDA a year ago, and their margins remained about the same, 25.7% this quarter versus 25.9% a year ago in the 3Q 20 quarter. They had strong subscriber growth, which offset sports timing impacts on advertising. Warner Media revenues were up around 14%, driven by strong direct-to-consumer subscription growth and content licensing. 3Q21 includes $200 million around in DirecTV advertising revenue sharing costs and direct-to-consumer subscription revenue growth of around 25%. So strong HBO Max subscriber growth in Latin America, Spain, the Nordics launch in October, international and AVOD subscriber growth more than offset the impact from Amazon wholesale losses. So they're basically saying, I think domestically, they had a lot of wholesale accounts for HBO Max through a deal with Amazon. They lost some of those, but their international growth, like we pointed out before, made up for it. Now, direct-to-consumer subscription revenues hit $2 billion in this quarter, up from $1.6 billion a year ago. Their global HBO Max and HBO subscribers we talked about hit 69.4 million, so that is close to 70 million now, up from 56.9 million. And they are saying that they believe they have a really good slate coming for the fourth quarter, and I agree with them. I think this is going to get a lot of those domestic subscribers back on to watch some of these shows and movies. Now, we're obviously in Q4 right now as I make this video. Succession is out and airing, and I know a lot of people watching it. I think it's a great show. I think that's definitely got a lot of attention. Dune was extremely, an anticipated movie by a lot of people. I think that's definitely helping. You have the Serena Williams biopic, and then you also got the new Matrix movie coming in Q4. So I think Time Warner, Warner Media, they basically have a really great content slate for Q4. I think almost all the entertainment companies are really going strong for Q4. Q4 is always a really big quarter, or, the end of the quarter. I'll say Q4 for them. It's Q1 for other companies like Disney. Now, their next earnings report, where they are going to talk about Q4, will be on January 26th. So something to keep in your calendar if you're interested in own the stock or want to own the stock or want to wait and see how they do for Q4 before buying the stock. But when you own AT&T, understand that you are also going to be getting shares in a new media company when AT&T basically spins off Warner Media to merge with Discovery and to create a new company called Warner Bros. Discovery. This is the name and the logo that they first announced, Warner Bros. Discovery, the stuff that dreams are made of. Now, this basically new company is going to exist outside of AT&T. Discovery itself shares, if you own Discovery shares, they will disappear and become Warner Bros. Discovery shares. If you own AT&T shares, you will get shares of Warner Bros. Discovery, and you will still also hold your AT&T stock. So the Warner Media times Discovery deal, AT&T is spinning off Warner Media to combine it with Discovery, a transaction expected to close in mid-2022. Pending regulatory approvals, of course, and under the planned Warner Media spin, the telco, so AT&T, will receive $43 billion in cash to pay down debt, so that's great to lower that debt. And last week, Discovery said it projected that the combined entity will have a debt ratio of 4.5 times annual earnings before interest, taxes, depreciation, and amortization, down from the previously expectation of 5 times EBITDA. So it is going to be high debt still. Now, the CEO of Discovery will be running this Warner Bros. Discovery company, and he has said that streaming will be the primary focus. He hasn't specifically detailed how the company's go-to-market streaming strategy may change under one roof. In the past, he labeled Netflix and Disney as formidable rivals, but reiterated his claim that combined, the Discovery Warner Media will have a bigger content library than Netflix. So something to keep in mind. They do have a ton of content and really high quality brands. So I do believe this new company, Warner Bros. Discovery, will compete in a strong way in the streaming industry. I don't think there will be a ton of winners, but I believe Warner Bros. Discovery, Disney Plus with everything they own, Hulu, ESPN Plus, etc., and Netflix will all be in the game for the long run and all be winners in one way or another. Now, as an AT&T shareholder, you will get 71% of the new entity's common stock shares, like as a whole, AT&T, the company will. You yourself won't get 71%, but you will get your portion. So while also retaining your existing AT&T holdings to keep in mind. So Discovery shareholders may gain more shares of the new company if you go 1-for-1 shares, but AT&T shareholders will not only get shares in the new company, they will still hold their AT&T stock. So you will be getting your AT&T company stock that you have today, that won't go anywhere, and you'll just be getting new shares in this other company. Now, what I like is that AT&T will be a more focused company with less debt after removing, DirecTV that they got some money for and whatnot, and Warner, and move some debt off that, and Warner Media. Once that's all basically off of the focus of the CEO of AT&T and just the company of AT&T itself, their focus is going to really just be harnessed in on, fiber, mobility, 5G, being a true utility like a Verizon. And I think that will make them excel at that job because they won't be spreading their focus. And then you get the shares of Warner Bros. Discovery, and that will be a extremely focused company as well, not hoping to, just let's bundle with AT&T and give it away for free or this or that to help AT&T subscribers. They'll have their true focus on what is best for this media company on its own. And I think that is the way the business should be run. I think they are better separate than together in this case. Not always, but in this case I do. Now the valuation. So today, the Warner Media assets are being valued very cheap because they are owned in a bigger conglomerate of AT&T, a utility company with high debt that trades at a super low PE. Now, Warner Bros. Discovery will be able to fetch a higher multiple on its own versus under AT&T. I believe splitting this asset off will give investors an almost immediate value add based on investors giving the new company a higher multiple. So example, Disney's forward PE is currently 30, Netflix's forward PE is currently 47, AT&T's forward PE is 7.35. Now yes, I do know there are big differences between Disney because it has parks and all that, Netflix because it's a pure streaming play and doesn't have the risk of parks and all that, and AT&T, which is obviously a utility company and everything else it has, mixed with the media assets. But what should AT&T trade for? Now, I think streaming potential of the new media company will be massive. I do hate the massive debt pile the company has, and the company seems to be finally getting focused and optimizing, which I like. So here is how I look at it. I believe the core AT&T business will have a very little growth and cash flow growth ahead, but it will have high and good cash flow. Now, I believe the new media company, on the other hand, is going to have little cash flow to start, but it's going to have high growth because it's going to be competing in the streaming business. They're going to want to price it competitive, getting as many subscribers, and then continue to increase the price over time. So you have these two assets that are kind of opposite of each other in some way. Now, what should AT&T trade for? Well, the company did $27 billion or so in free cash flow in 2020. Since you're going to own both AT&T plus you're going to own Warner Bros. Discovery, I believe about an 18 times free cash flow is a fair price because you're getting, the growth from one company. And I'm saying as a combination because right now you can't pick or choose. I'm not talking about what AT&T will be on its own after this is split. I'm not talking about what Warner Bros. Will be on its own. But I'm saying if you buy AT&T today, since you know you're going to get Warner Bros. Too, I think about 18 times free cash flow is fair. So 27 billion times 18 is 486 billion as a fair market cap. Now the thing is, and when I say market cap, I actually meant enterprise value, because the current market cap is 164 billion. You have to include the debt. So 164 billion of market cap, you add on that $209 billion of debt they have, you have 373 billion then. But you got to take off, they have cash on hand too. So we take off that cash of 21 billion. And in reality, you're paying for this company with debt, cash, everything there, $352 billion. And that is what is considered in the term enterprise value. It includes the cash and debt levels to the market cap. So $352 billion of about an enterprise value. I believe their enterprise value should be around 486 billion. Now that's quite a difference. And it actually starts to substantially make a difference in the stock price because that $134 billion difference needs to be added to the market cap. It doesn't affect the debt and cash. So the market cap that's currently at 164 billion, if you add that 134 billion to it, you get a total market cap of around 298 billion. Now, there are 7.14 billion shares outstanding in this company, and if I believe their fair market cap should be 298 billion today, including debt, all these other things, then that would mean basically a share price today, a fair share price of $41.74 from my math. So the stock is trading for like $23. So now that we've done the math, we can understand why it could fetch around a $40 share fair value today, and it has been around 40 in the past. Obviously, AT&T still needs to prove it can execute well on all these focused objectives, and Warner Bros. Discovery still needs to get merged out and prove it can compete in streaming. So there are still a lot of risk, and because of that, I wouldn't pay that fair price of $40, and I don't expect it to hit that $40 share anytime soon. But at $23 a share, I kind of think it's a steal of a deal. I think that you are getting such a discount to fair value that I'm willing to take those risks and hope that they do execute properly and buy in at these prices. So needless to say, I am buying a lot of stock currently. I do like this company. I like a lot of the media companies right now, as you could tell from my past videos. Huge Disney shareholder. And tip ranks, for just an example of what other analysts think of the stock, they give a 12-month price target currently of $30.57, representing around 32% upside. So their fair value showing around 30. They have a high of 36, a low of 26. Even on their low targets, $26, we're still talking about a really nice gain from the $22, $23 range it's been in the past day. So I do think it is a buy for me. I like it. I'm curious if you're buying AT&T. Definitely comment below. Do you own it? Do you like it? Sometimes these stocks can be value traps because of the dividend. Dividend will be cut, but I don't really care about dividends, to be honest. Just a quick secret. If they don't pay a dividend at all, it just stays in the balance sheet. It gets priced into the actual stock because then it's in cash or it's paying off debt. So at the end of the day, dividend or no dividend in a company doesn't really matter to me. All that matters is you take everything into account and it all works out. Either the stock appreciates or you get paid out a dividend. Either way, same thing. Are you buying AT&T? Do you like the company? Definitely let me know. If you haven't liked this video and you made it to the end, please smash the like button. It takes a lot of time to make these videos, and I appreciate you all. Subscribe if you haven't subscribed. Until next time.